Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike
Zlotnik, and today it is my pleasure and a privilege to welcome back my two good friends, Willie Goldberg and Paul Hersko. Hi, guys.
How are you?
Hey, Mike. How are you?
Doing well. How's the world treating you? You are the discount lots guys. I can't put it any other way. So, how's the world treating you?
Yeah, things are good. We can't complain. We just had our quarterly planning Monday and Tuesday of this week. So things are looking good for us. We had a record month last month and strong month this month. And set some good high goals for ourselves. And we're excited about next year and where we're headed.
And that's a weird thing to hear today. We're recording this podcast in late December, right before the holidays. So happy holidays. That's we got to mention that. Hope you guys have awesome holidays and great 2023, happy and healthy. But most people are saying, well, we are about to hit the recession and we are gearing up, we're tightening up, and you guys are looking forward to an exciting year. So give me a little color here. How's your business different from the rest of the world?
Sure. So yeah, as you mentioned, a lot of people in the traditional real estate space, I guess real estate space in general, they're obviously, expecting not such a great 2023 as, mortgage rate or interest rates are changing, liquidity is changing, and demand is softening because it's harder to get a loan on property, right? So they're struggling, days on market's increasing, and for us, we're knock on wood, we're experiencing the opposite because the way that our business is set up is not dependent on interest rates so much. We kind of operate on our own ecosystem. So for those people that haven't listened to us on the Big Mike podcast before, we run discountlots.com, which is we basically sell land online through owner finance with it's as simple as swiping your credit card, and we charge your card on a recurring basis, and you can use the land while you're making the monthly payments. And so for us, things are a little bit different because it's our own ecosystem, and the prices that people see on our website are not as dependent on interest rates, because we're offering the financing to the consumers on the front or on the back end. So for us, we're expecting 2023 to be a great year because we have so much low-hanging fruit within our own ecosystem to fine tune and to fix and to grow. So for us, we're expecting some growth in 2023 because, as our business is maturing, we're tightening our systems, we're getting better at marketing, we're getting better at sales. And for what we're doing, there's still a massive amount of people that want to pay $300 a month to invest in the future or to build their dream home, whatever they want to do with the land. And as affordability of a home becomes more and more difficult and out of reach, the more attractive our offer starts to become because it's an alternative to traditional real estate, and they can get their foot in the door for a low monthly payment, and it's a very simple process. So from our ecosystem, we're the data is coming out differently than the traditional real estate, and our expectations is different than the traditional real estate. I know there's probably a lot to unpack there, but that's kind of what we got going on in our neck of the woods.
Yeah, that's a great explanation, Paul. I appreciate that color. Although it's difficult to compare buying a primary residence real estate versus piece of land, or maybe an investment real estate. I guess the comparison wouldn't be a primary. It'd be more like an investment real estate versus a investment land.
For our audience, or not our audience, but our client base, a lot of them are people that might have rented their entire life, or they don't own anything right now and they want to own something, and they want to have their first foray into real estate investment or ownership. and we're making it very easy and simple. Whereas, the idea of them owning a home is becoming more and more out of reach. So our field that we're playing in is more of the, how do I say it, not the sophisticated investor, but someone that is maybe looking for an alternative to park their RV or to live in an Airstream or to have retirement in the future. And they've worked a traditional job and maybe they've been renting their entire life. We're kind of providing servicing the alternatives.
Yeah, I got you. So you don't do traditional underwriting. This is not their primary residence, not subject to Dodd-Frank, not subject to debt to income ratio. So how do you approve somebody who wants to buy? What do you look? Do you look at their bank statement, or we just $300 down, $300 a month? As long as you make the payments, you have that land use, and if you stop making the payments, you lose all the payments and you lose the land contract.
Yeah,
I guess your underwriting is pretty light, right?
Yeah, I'll let Willie answer that because that's, Willie, for those that don't know us, he's from the investment banking world before he did this. And, he's the mastermind behind the unit economics of this crazy business that we run.
So the beautiful thing about our business is that we keep the title while consumers are making payments, so that you can think of it as sort of rent to own type contracts. So for us, there's no foreclosure costs, there's no legal fees when if a customer does default on a property. So for us, there's no real advantage to putting more friction at the point of sale. So basically, we make the buying experience as easy as possible. We want to be the easiest place on the internet to buy land. And so that's kind of the ecosystem that we're creating. So we don't do any underwriting up front because there's really no incentive for us to do so. Because like I mentioned, if there is a customer who's unable to make payments, we simply send a kind of a default notice, wait 30 days, remarket the property, and obviously keep the payments that consumer had made. Obviously, we want consumers to go all the way through and buy the property, and so we can deed the property to them, and they can make their land ownership and own the property. But for us, there's no real incentive to do so. And so our game right now and what we're playing is we're selling 100 to 150 lots a month. We're trying to operate at volume, and that's kind of the business model that we play in.
Gotcha. And just refresh folks, what's your average today purchase price on that lot, and what's your average sale price? And there's a massive difference between the bid and ask. And when you talk about average purchase price, I mean with all the overhead. So like, what do you typically pay with all the overhead and all the folks you have to get a lot? And then what do you sell it at?
Yeah, so for us, it's about $4,200 is average purchase price. We'll sell for around $21,000 on average. On average, we sell it over 5 times our purchase price, between 5 to 6 times. That's just the raw cost of the property. We've got marketing spends. We drive traffic to the website, Facebook ads, Google ads. We've got a sales team. So we've got operating expenses associated with each property sale. So if you add it all together, we're probably all in around $6,500, $7,000, and we're selling it for around $21,000. So if all in $7,000 to $21,000 is kind of so 3x multiple on our all-in cost of a property.
Yeah, it makes a lot of sense. And I guess you don't charge any interest. You just basically put a payment plan over, well, what is it, typically 6 years?
Yeah, so yes, 7 years is probably average for us in our portfolio. So we charge 0% interest. We're marking up a property on average 5 to 6 times. So we're doing what's right for the consumer. We're selling a property. The key to our entire business model is that we're able to buy properties at major discounts. So we're buying property at about 20 cents on the dollar on average, 15, 20 cents on the dollar. And we're selling property at around market value. So the value that we're really providing is to the consumer. We're providing a great value to them because we're charging no interest and we're selling property at market, and we're offering terms that they couldn't get anywhere else in a space where banks are unwilling to lend because administratively it's difficult and banks don't want to deal with the collateral. So we're solving a real problem in the marketplace. So yes, we charge 0% interest because that's the best outcome for the consumer.
Yeah, that makes sense. Let me go back to the original question. So we're going into a recessionary environment, and everyone kind of knows about it. Plenty of leading indicators are stating that we are going to hit a recession. Now, technically, we're not in a recession yet, but we are in a likely upcoming recession. So you're not sensitive to the interest rates, but your business is sensitive somewhat to the recession. So, and we're working with you guys for multiple months and years now, and we've been kind of having these monthly calls, reviewing data and looking at this stuff carefully. But what are you projecting or expecting during a recession environment? How much delinquency increases you could see? I'm just curious, kind of like downside protection. And we run stress tests with you guys, and I've looked at this stuff. I'm just curious, what are your thoughts in a moderate to severe recession? How many people will actually stop paying?
So I think it's a two-part question. And I can Willie can answer the second part of it, the like stop paying part. But for us, I think the main thing that we need to pay attention to is like, so one of the beautiful things is that our margins are so high. So that means like we're not selling a widget where we can only afford $5 of marketing, and if you know the marketing is $7, we're losing money per unit, right? So if and when the recessionary environment becomes tough, and basically what that means for us is our marketing spend probably will have to increase. So an increased it may cost more money to acquire that customer because there's potentially less people that want to buy land. But in the universe of buying land, there's millions of people that want to own land. So for the first part on the front end, I the way that I see it is it may become tougher to acquire customers, but I don't think it's going to be like, okay, there's no more customers, because, you know, it's not like there's someone saying we're not going to lend to you anymore, or the price is astronomical for the lending, so therefore, you know, you can't buy anything. So I see it from a marketing perspective of costs may increase. And Willie, I think you should take that second part of the question.
Yeah,
Does that make
so
sense, Big Mike?
Yeah, that makes sense. That's a good argument. It's going to be harder to get a customer because less people working, more people laid off. So you got to spend more dollars to acquire a customer. That argument doesn't make sense.
Yeah, the one thing to add to that is that, like I mentioned, we have so much room in our margins that we can afford to, even if our costs tripled, for example, to acquire a customer, our margins are still like way better than most businesses in the industry. So there's so much room in our margin that, you know, in a really bad environment, we can still afford to take that on. So that's kind of like the front end side of it.
Yeah, understood. And then the other bigger question is, Willie, to you, I guess, what do you think is going to happen with the paying customers? I guess some of them get laid off, and this is not like a critical expense. So at that point, I guess they're forced to walk away from their land.
Yeah, so I mean, our normal charge-off rate is between 1% and 1.5% a month in our portfolio, and so we have obviously a very comprehensive operating model where we forecast where our company's going in the next 12 and 24 months. Obviously, we work together to forecast. Okay, so unemployment goes up, and now delinquency goes up, and we think our charge-offs also going to go up. Where does that put our company? So we feel very comfortable with where we stand. So yes, we like if unemployment goes up, certainly the unit economics get a little bit worse. So when we work together, we forecasted a 2, 3, 4x increase of our charge-off rate or delinquency rate, and kind of show where does that put us in 12 months? Where does that put us in 24 months? And like Paul mentioned, because we have so much margin in our model, we're still going to be okay under kind of extreme stress scenarios. So if you think about it right now, we talked about our example of a deal looking like, okay, we bought it for $4,200, all in, we're in at $6,500, $7,000 to acquire customers, stick in our portfolio. So if unemployment goes up, and say our charge-off rate goes up, and now it costs us more, like Paul mentioned, it costs us more in marketing spend and sales spend to get a customer to stick in our portfolio. So rather than being all in at $6,500 to acquire a customer, to kind of pay through all the way to the end, maybe now
Well,
it
and the
costs
and the cost of land too.
yeah, maybe now it costs 7,500, 8,000, 9,000 to acquire a customer because we're buying these lots. And again,
And one thing that just popped in my head, actually, sorry to cut you off, but I think it's really important for the sake of this argument is recessionary environment gets way worse. Our ability, the price of the land for us to acquire it is going to decrease. So, it'll cost us less to acquire that piece of property. And then that chunk can be put towards marketing. So it's pretty obvious the worse the economy gets, the lower prices drop. It's not like real estate prices will continue to increase if the recessionary environment gets worse because there won't be any buyers. So I think that's also important to add.
Yeah, so I think that the bottom line is that our unit economics will change slightly in a stress scenario. We're prepared. We've modeled out. We've put extreme stress scenarios, and we feel very comfortable on that our model functions. And we just had our quarterly and annual planning. For us, we don't even think we have so much low hanging fruit on things to fix, systems that we can tighten, and we kind of hired a new person on the marketing front who we feel very comfortable in saying that the conversion per all things equal, we feel very comfortable saying that we're going to be able to convert a lead twice as often into a sale with this new person in the space because of the low-hanging fruit that's in front of us. So we feel very comfortable saying that we have a lot of systems to tighten. We have a lot of improvements to make in our business, in our business model that we're very comfortable forecasting what we are for next year and very comfortable with the model right now.
Yeah, I appreciate that caller. It does make sense. Again, if there's a recessionary environment, you can get a better price on the acquisition. And I guess in general, you don't really discount the price; you just increase the marketing. So you're still going to sell that lot for 22,000 or 25,000, and it's going to spend more money on marketing. And then the other thing, again, if somebody stops paying, so if the delinquency rate increases, you don't need to acquire more product. You already have the product. You just remarket the product. From that perspective, you don't need to spend new acquisition dollars to buy the asset, right? You already have the asset.
Yeah, and we're closer to the break-even price of that property, because the person had been paying for X amount of time, right? So that is some of the positives. One other thing I think that I'd like to add is if you think about any sort of traditional real estate product, industrial, commercial, whatever it might be, they're really at the mercy of the market and the banks, right? So for us, we have levers in our business that a traditional, call it a flip business or a fix and flip, they don't have. They're really at the mercy of what rates are the banks lending at and what buyers are available in the universe. For us, we have the lever of being the bank and also being able to acquire customers not in the traditional sense of the MLS, right? We have the entire internet and traditional marketing to play with. You're not going to see someone running a television ad or a television ad for a single property, right? It's going to go on the MLS, and they're going to go through their traditional methods. So we have more levers to play with in our business versus a traditional business, should environmental things change.
Yeah, that's a pretty good point, Paul. I appreciate that caller, because if you think about it, we are in the great mastermind of the collective genius. We've been in that group for I've been in the group for many years. You guys been there also for a number of years, and we've heard this story that many folks are seeing slow down business substantially this year because they can't buy right. The sellers don't want to sell their properties. They don't feel the pain enough, and then the construction it's gotten somewhat harder and more difficult during the COVID, and the exit price is also uncertain. So there's more volatility and more uncertainty in those businesses. And they are capital heavy. Your business is is not capital super light, but it's again because you're buying relative to the sale price at such a reduced price, 20%, as you Willie pointed out. I guess your maintenance of the business is not that expensive. But let's go forward. So again, into next year, you guys are looking for a great year, and we continue to fund a good number of deals with you guys from Tempo Income Fund through the discount lots units that we have in the fund. So our investors participate, and we loan the money to you, and we pay our investors. That creates a happy situation for everyone. But what would it take to unwind the portfolio if like a stress scenario hit? I'm sorry, I'm just trying to basically discuss a challenging scenario and what are the good case scenarios. You just guys continue to basically acquire lots, continue to sell. You're not really seeing economic stress conditions, as you're not sensitive to interest rates. Maybe increasing unemployment going from 3.7% to 4.7, 1% increase is not really going to majorly impact you. So what do you guys think? Kind of the good, the bad, the ugly scenarios.
Yeah, I think let's start with the bad. We'll go from bad to good. Get that out of the way and end on a high note. So from a bad perspective, the way that our business is set up is the money, like for us to all of our expenses, majority of our expenses are going towards growth, right? So buying new property, acquiring new customers, and then servicing those new customers and getting more traffic to our website. So that's where all of our cash, like where all the cash is going, that's being invested in our businesses for growth. You know, at the end of the day, if there was a catastrophic earthquake and, World War III breaks out, from our perspective, I don't know, Willie, what, 80%, 90% of our overhead is associated with growth of the business. In an insane scenario, all we'd have to do is just take care of the portfolio. So winding it down to just a few employees, and all we're doing is servicing current buyers and collecting that cash and saying, okay, there's no more growth, and selling off, anything that's unsold to wholesalers or whatever it might be. But from a horrible catastrophic situation, it's let's just maintain this portfolio, get rid of all the overhead that is for growth, and that monthly number is pretty low to maintain that. So that's like the horrible, catastrophic World War III situation.
Yeah, I think Paul nailed it. Like all of we're investing in infrastructure, we're investing in marketing, investing in sales.
Tech.
If we ever needed to, we can get super skinny. Paul and I service the notes, whatever. All we need to do is service the notes, and we've got plenty of recurring cash flow coming in on the payments of the land. So right now we have over 2,000 paying customers that significantly is much greater than any debt service that we have. So basically, if we ever needed to, we could become a servicing company, service those 2,000, 2,100 notes, and cover debt service and minimum obligations. So we have a lot of margin in there to do that.
Yeah, I appreciate that. That's a stress case scenario, and I certainly don't want to use the word World War III or any other.
That's like an extreme test stress. That's like, even if there's like a bad recession, we don't expect anything close to that happening. So just want to make it clear, like that is like a horrible situation, like horrible.
Yeah, I hear you. What is the more realistic kind of view? What sort of what happens in a less stress scenario, more realistic? You guys continue to grow, just continue to acquire more lots. And where are you trying to acquire more lots? Which markets do you like to acquire more lots in? And where's the demand? Where people are buying nowadays?
Sure. Yeah. So, we're projecting, last year we had 70% growth. We're projecting a little bit more than that for 2023, even with the, for the reasons we stated earlier, why we're kind of playing in this different sandbox. We're expecting growth in 2023. And we're expecting to do that by tightening a lot of systems, by increasing marketing spend and acquiring more diverse properties. So as our business is growing, we've learned, when we first started the business, it was based off of data. Like, these are where the transactions are happening. These are where, these are tried and true markets. Okay, great. Now we have a huge customer base and we have lots of leads, and we're listening to our customers and understanding what they want. And what we're learning is that people want like 5 acres in Minnesota or, in Missouri. Just, people want the things that we didn't really expect, and we'll get stuff in Alabama or Minnesota and it'll sell within a couple of days. We don't do any marketing in Minnesota. So what we're learning is people want affordable land that is good acreage, that has, utilities and can be used for things. So we're trying to get a little, like, as we're selling some of the older stuff, we're trying to diversify our portfolio more to, attract the person that maybe wants to go hunting in the Midwest or camping with their family in the Southeast. And so kind of diversifying out of our bread and butter, which has traditionally been California and Florida, and having some more options for the consumer as, we're getting more leads from other states and people are requesting more things. So 2023 is, for us, is tightening systems, getting better at marketing and sales, and having a little bit more diverse inventory.
And that's a great point. You want to go where your customer wants to go. So
yeah, not the data. Well, the data, but the customer data, not the open source data.
Yeah, understood. But if your company wants to get land in Minnesota and you don't normally market in Minnesota, how do you find those lots for them in Minnesota? So if you are buying in Florida and you're buying a lot of lots, and you can buy them at foreclosure auction, you can buy them at the tax auction sale, you could buy them through marketing, because you have a footprint there. But how do you change and go to Minnesota if you have one customer in Minnesota? Is there any particular way you could acquire these lots, or it's just you become more of opportunistic? If you see great lots in Minnesota, you'll pick them up if the price is right, and then you'll find a buyer for it. I'm just curious, how do you adjust if your demand wants land where you don't have a footprint?
Yeah, so for us, traditionally it was, okay, we got to like send out mail and a lot of budget towards it, and then see how the market reacts to see if people are receptive to mail or not mail. So now we've really built up our cold calling team, and we can just have one of our team members download data, and we could put 1 or 2 people on it, and within a week we're going to know what price we can offer, how receptive they are, and if it's an easy or not easy market. And we don't, the costs associated with that are basically nothing, just labor. Whereas before it's $5,000-$10,000 to get into a market. So now we've gotten a lot smarter, nimble, and reduced expenses for testing and trying new markets. And if they are receptive, okay, let's buy 2 or 3 properties, make an investment in this area, 3 properties at $4,000 a piece, $10,000-$12,000. And okay, hey, we're in a new market. Let's see how this does over 60 days. If it doesn't go well, okay, we tested it for $12,000. Whereas before it was like allotting all these marketing dollars towards it, where we've really simplified the business. And so we're looking to scale that up in 2023 of just more simple, easier, less overhead.
Yeah, the KISS theory. Everyone wants to go to the KISS theory. Keep it simple, sir.
I like that.
So your goals are pretty good volume, right? You're trying to do well above 100 lots a month, right? And how do you get enough inventory? And what markets? I'm just curious. Again, if you go into testing a market and you can pick up a couple of lots there, maybe 5, 10, that's still a small footprint. So I'm just curious, what are you thinking about the acquisition side, getting these great deals? Because it sounds on the disposition, you continue to strengthen through your website, and the more customers you have, the more referrals, the more they want to buy. But you need to continue to bring quality product in the markets that they want to buy. So I'm just curious, how are you picking up new stuff?
Yeah, so I think we've got a in-house team that does our closings for us. So we've got a couple people that work on the closings. We do a lot of title closings. So we've got a title team that transaction coordinator and some assistants that work on that team as well. But like Paul said, the top end of the funnel for the acquisition side is those cold callers, the direct mail. Those funnel into our system, and then we've got a team that kind of negotiates the deals that we actually want to purchase. So that's kind of how that works. Each of them have their KPIs and the number of deals that they have to hit. And then we have the in-house title team that kind of closes all the deals. There's two guys. There's two guys that help us with kind of self-closing of deals. We do our own title searches on a lot of these properties, but most of our deals are going through title companies, and so they just go through to the title company. We do a lot of deals that are in bulk, so we'll find some sellers with 5-10 lots at a time and make a package deal with that. So it makes it a little bit easier operationally when we are able to find those deals. But the one thing that we do super well is, like Paul mentioned, we go direct to seller. So a lot of our competitors in the space, so there's some competitors in the space who have been around 20, 30, 40 years. Their model is the exact same as ours, but they buy their properties at tax auction. Our experience with tax auction is it's super easy to buy property at scale because you could buy them all in one place. But those are actually super competitive markets.
And low quality.
They're unwanted land because people inherently didn't pay their taxes on the property. There might be a reason they didn't pay the taxes, but also there's a lot of eyeballs that are looking at those deals and making competitive offers. We went last tax auction we actually went to. It was just, the prices were insane. Like, we're getting these deals off market, direct to seller at maybe half to maybe a third of what we can get at the tax auction. So we like going direct to seller, and I think that's part of our the great part of our business model is we're getting higher quality properties in direct to seller with no competition. So, but yeah, that's how we do it. We've got an in-house self-closing team that does the title searches, and then we've got a title coordination team.
And one thing to add to that, if you think about like someone that's in the housing, like doing houses or whatever, it's a slow moving dinosaur, right? Like, the person lives there, they gotta, like, they have an emotional attachment to it. There's all these things, call it baggage, associated with, for example, a building or someone's home or just anything in land. It's normally a very fast transaction. Do you want to sell your property? Yes or no? 9 times out of 10, it's a simple yes or no. And if it's yes, it just comes down to price. Whereas a home, it's like, where would I go? What do I need to do? I've lived here for 30 years. I don't know. The uncertainty. Whereas land is just like, they haven't used it. It's been sitting for a long time. They don't probably live there. And 9 times out of 10, it's just them paying taxes with something they don't really want. So, we're able to move really fast and get feedback very fast on areas versus, going after houses, for example.
Yeah, that's pretty cool. Direct to seller makes total sense. And I can tell you from the sort of years of experience that the auctions, and by the auctions for land auctions, for again, tax auction versus the property auction during, if you remember 2008, 2009 crisis, again, you guys were a little bit younger then, but you were probably not in this business. But I could tell you that there were essentially cycles. So land auctions, the foreclosure or tax foreclosure or mortgage foreclosure auctions at some point of time became incredibly attractive because there was a lot of product and few buyers. So if you time it right, you may see the same thing on a tax auction. It's not attractive until the market changes. And suddenly there's a lot more product and no buyers. And usually that's the time to come in and actually pick it up because you are at that point paying a really good price. So just a quick comment. Anyway, I appreciate this was really great. Any parting thoughts? Any other feedback for 2023? Kind of what folks can look forward to. Obviously, your model is a great model. We love working with you. It's one of the few investments that we have. It's an income product. It generates our investors strong yield, and we loan you the money, and you basically buy those lots, and then you sell them 5x, and everybody seems to be happy. The math just works. So for us, we're happy with this relationship because finding income product in this environment is not easy. You're one of the few strategies that can actually generate income from normally like land doesn't reproduce. It doesn't generate any yield, but you found a way to turning land into receivable to generate pretty strong yield. So it's a powerful concept. And for investors, it's a great opportunity to get into this strategy, generate great yield. And obviously they have to kind of know, like, and trust you and love what you guys are doing. And anyway, any parting thoughts working with you guys?
I mean, we're optimistic for 2023. And yeah, we think the business will continue to thrive and grow. We're going to focus on refining our systems and making things a lot better. So if anyone out there listening is kind of interested in earning a fixed, consistent, stable return on their investments, when the stock market's fluctuating, crypto markets are collapsing, and other real estate niches may be less certain, contact Big Mike, because we'd love to have you as an investor working with us.
Thank you, Willie. Appreciate that.
I think Willie put it best. Only thing I'd like to add is, if you are looking to get an alternative investment that doesn't, rely on other things such as like, mortgage rates or what interest rates, talk to Big Mike. And, if you have questions, Willie and I are always available to talk to anyone that might be interested.
Yeah, thank you, Willie. Thank you, Paul. You guys have been awesome to work with, so I appreciate the relationship. And you certainly always impressed by your expertise in your own business, and it as kind of as the back of your hand. It's just, I don't think anyone else knows this stuff better than you do. And I've interviewed other folks on my podcast, kind of the Land Geek and other folks, and with all due respect to them, it feels to me that you guys know better than they do. And some of the veterans in the industry been kind of the old dogs, and you're the new dogs. Technology driven, very marketing driven. It's a very different approach to what has been for years an old business. Land buying and selling as receivables has been around for many years, but you've taken this to a whole new level. So congratulations, and good luck in 2023.
Thank you. We're excited for the ride.
Thank you kindly.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnik. Keep listening and keep investing Big Mike style. See you on the next episode.